Greetings, people. My name is Stephen. Welcome to your masterclass, Investing in Distressed Commercial Real Estate and the Code to Generational Wealth. Thanks for showing up. It's my honor to share with you what I've learned over the course of my 30-year career in banking, real estate investment, real estate asset management. Like you name it, I've done it. Long career, and I've really enjoyed it. As you'll find during the course of this next hour or so, I'm very passionate about commercial real estate. Um, so I'm the CEO and Chief Investment Officer of Performance Advisory Group. And what we do is we teach, we invest, and we advise all things distressed commercial real estate. My history is that, again, I've been in the commercial real estate business either as a banker, investment banker, investor, advisor. I mean, again, you kind of name it, I've done it. I've done more than $11 billion of transactions over the course of my career. The vast majority of those were in underperforming loans or underperforming real estate that was in default or likely to be in default at some point here in the near future. I've bought more than $600 million of multifamily over the course of the last 5 years. Most of it subperforming, although I don't think any multifamily assets today are subperforming. It's been such an extraordinary run. I'm a contrarian thinker, and that means that when things get difficult, I look at it as a huge opportunity, and I prepare in advance for it. And that's part of what we're going to be talking about today. Today, I'm going to share with you a variety of things, but I'm going to talk about specifically one, where we're at in our economy. This will be my fourth downturn, and although history doesn't repeat itself, it rhymes. I'm seeing extraordinary similarities between now and both the Great Financial Recession and the dot-com bust. I'm also an investor. Obviously, I've done a lot of investing, author, speaker, consultant, teacher, and I got investor on there twice. Oops, we'll figure that out. Don't follow the pack, disrupt it. When things get difficult is when extraordinary opportunities come to play. It's not following the pack mentality. It's investing when everybody else is selling, and it's sometimes selling when everybody else is buying. That creates that generational wealth, and particularly as it relates to commercial real estate. So what created this opportunity? First off, it was an unprecedented injection of liquidity by the Federal Reserve. And I'm going to show you the chart in a moment, just mind-boggling. And then compounding that with artificially low interest rates, we inflated bubbles in virtually every asset class. Combined that with excessive exuberance and pack mentality, everybody was jumping in when the numbers were going north. You ended up with just incredible buying and escalation of valuations. And we also forgot a lot of the lessons of the past. And by the way, that happens every time. When things are good, we forget what we did wrong last time. And boy, yeah, bottom portion is it was never about supply. It was unprecedented, unsustainable demand. And let me show you why. This is a chart of M1, and this is produced by the Federal Reserve. M1 is the money that's in your pocket, the money that's in your bank account, checking account, safe deposit box, maybe you're safe at home. It's the money in circulation. Going back to 1960-ish, there was about 900 billion in terms of cash in circulation, and it grew over the course of the next, 50 years. And that simply happens because population grows, and we need more money in circulation. Business also grows. So there was a steady growth, but then notice here in 2009, sort of in the midst of the great financial recession, Ben Bernanke, who was the then head chairman of the Federal Reserve, turned on the printing presses, and he did so in a fairly measured way. So note that over the course of the next 11 years, M1, or the money in circulation, moved from about $2 trillion to $4 trillion. So he doubled it over an 11-year period. This is where it gets really scary, and it's mind-boggling. My undergraduate and graduate work was both as an economist and statistician. I know, boring. Would never have thought I would do that as a youngster, but I feel blessed that I got that done. because it gives me a certain perspective that might be slightly different than the general populace. Anyways, he grew, I shouldn't say he, Jay Powell, the current Federal Reserve chairman, with far too much power. And by the way, F the Fed, they have effed us in unbelievable ways. But he took M1, the money in circulation. He cranked up the printing presses like they has never like we have never seen in the history of the U.S. Frankly, not in the history of the world. And he added more than 500% more, 500% more liquidity. So he increased liquidity out there from 4 trillion to more than 21 trillion dollars in less than an 18th month period. Most of it almost overnight. Now, granted, we were in the midst the COVID pandemic, the worst pandemic in 100 years, but this is not measured. This is not measured by any means. Um, and again, he took interest rates to artificially low levels. And the way he did that was through what's known as quantitative easing. Quantitative easing basically means that in this case, he was buying about $30 billion worth of mortgage-backed securities every month, and therefore pushing down on the interest rates. Bonds, mortgage-backed securities trade based upon the demand. The more demand, the lower the interest rate, or the lower the yield. So he brought yields down to 2.5%, which, as you know, or if you watched any of my other videos, is what accelerated the housing boom in the middle of a pandemic to levels that we have never seen before. And the sad part is those levels are fully unsustainable. And as we predicted last year, it's taken a huge toll in the housing market. The good news, though, is this: that if you own a home and you locked in a long-term fixed rate mortgage, that might be one of your greatest assets ever, because frankly, that mortgage rate was subsidized by the U.S. taxpayers. So good for you. So this is also produced by the Federal Reserve. It's known as the Case-Shiller Index. It's a measure of housing prices, and this index is relative to Phoenix, Arizona, which, as many of you know, has tended to be one of the most volatile housing markets in the country. I'd put Las Vegas, Phoenix, Arizona, Dallas, Texas, and now I would add Austin to that equation, and then a lot of Florida in those markets that are highly volatile. So this is again Phoenix. In 2005 is around when we introduced this notion of liar loans. And basically what that means is that with subprime loans, anybody could have got them. You just needed to lie in your loan application. And what that did was hyper stimulated demand, just like we've seen over the last 2 years, for single family homes. And as you can see, it went, I mean, prices almost overnight went through the roof. They close to almost doubled over less than a 12-month period. And that's a direct consequence of the liar loans. But you also notice the other side of the equation, the other side of this curve, they overcorrected such that they price point was below where they started prior to the subprime loan catastrophe. The other thing I want to point out for you is that it took probably, okay, so this is 2013 here, and this is 2007. So it took 5-6 years for the housing market to really find a bottom. And guys, don't think that this is going to be all that different from that time. Again, we had the same fundamental challenge, which was overstimulation of demand caused by too much liquidity in the marketplace. Now, I will grant you this: today, the credit quality of the mortgages are far superior to what we had back then. And there's a lot more equity out there in the housing markets than we had back then. But look, a lot of that equity is going to go away too. And then you accelerated this demand over the course of the last 2 years by a lot of investors buying homes and using them as short-term rentals. That market is struggling today, and that's going to create, as a result of defaults and foreclosures, more inventory than we have seen probably in more than 10 years. So, by the way, that's just an opinion, obviously. But I'd like to think it's an informed opinion based upon my history with real estate. So I say, this is Bitcoin. I did a video log about a year and a half ago. It was May of 2021. And I was talking about all the things I've shared thus far, which is the Federal Reserve's hyper aggressive quantitative easing and monetary policy. artificially creating demand and creating bubbles in virtually every asset class. Now that's true, guys. It was not just single family homes. It was commercial real estate. It's stock market. It's the price of lumber. It's used autos. There's nothing that was exempt from those bubbles. So here's Bitcoin, and I'm not going to spend a lot of time on it because frankly, I'm not a Bitcoin expert. But what I said at the time is this. Um, Bitcoin is not a currency. It at best is a commodity. I love the blockchain aspect of it, but there is no validation for it to be a bit of currency. And I said that, and this is when I did the podcast right here in May. I said that the underlying cost to create a Bitcoin is about $8,000. There's no moat. There's no barriers to entry. All you need is a computer, access to the internet, and energy, and anybody can create them. There's no reason in the world that should be trading at 800% of its baseline cost. That's a margin that should not exist. And the only reason it existed is because of stimulus. Now we know at this point Bitcoin's retraced almost back to $10,000, maybe it's $15,000 today. But my estimation, my hallucination is that it's not likely to stay far above its baseline cost. There should be a margin there, but that's ridiculous. Now, this is the personal savings rate, which is also produced by the Federal Reserve. This is kind of what I'm talking about here. That all that stimulus that the Federal Reserve created through stimulus checks, PPP, quantitative easing, et cetera, all of that combined to create extraordinary wealth for the average household, for the average person here in the US. These spikes here, as you can see, going back to 1950 something, highest it's ever been, and by an order of magnitude too, not just highest it's ever been by a little bit, but twice that its highest level, and certainly far higher than we were back here prior to the pandemic. That's what, eights, we spiked to 34. That's massive, right? That's a 24 point, no, 26 point jump. So 400%, if my math is right. But here's the sad part, guys. As consumers, we did what we normally do. We took that money that we had and we went out and spent it. We spent it on goods and services. And by the way, when I say goods, that explains the supply chain disruptions to a very large degree. Now, the other component of that obviously was China and their zero COVID policy, which is, again, in my opinion, ludicrous. But our forging on goods, telephones, TVs, computers, you name it, much of which is produced out of China, is one of the things that got our economy back on track, fortunately. But we did it to an extreme that should not have happened. This is not measured monetary policy. This is this is crazy stuff right here. And the reason why this is important is that the U.S. consumer is responsible for 70% of the GDP here in the US. In other words, you and I spending money on telephones and computers and you name it, cars, et cetera, are what drive our economy. 70% of our economy is a result of you and I buying things or services. We're broke, guys. We're pretty darn close to broke at this point. We haven't seen these levels since last recession. So that's bad news, and that does not imply good things in the near term. The other thing is this is a consumer sentiment produced by the University of Michigan, also released by the Federal Reserve. And this talks about how good the consumer feels about what's going on in the economy out there. And as you can see, we're at or close to all-time lows in consumer sentiment. Now, if you get back to this notion that you and I are responsible for 70% of their gross domestic product here in the US. So that's our gross net output. One, we're broke, and two, we're out of money, and we don't feel good about the future, so we're likely to tighten our belts. Exacerbate that by this ridiculous level of inflation, such that everything costs more. And guys, we're in for a rocky road. And I don't say that as a pessimist. I say that as pragmatic, but also what I want you to start thinking about is that we're going to see buying opportunities for every asset class that we're probably going to be generational lows. We're going to see opportunities to buy that are arguably once in a lifetime. So where do we go from here? Well, the Fed has told us time and time again they intend to stay their course. with the intent of crushing inflation, which I didn't mention this, but inflation's at or close to a 40-year high. Let me just take a step back and say the Federal Reserve is responsible for three things primarily. One, inflation, and they have effed that up to a huge degree. I mean, literally a 40-year high, guys. Two, price stability. How'd they do on price stability? Well, they suck at that too. I mean, literally prices have been all over the board for the last 2 years. So that's an F in both of those categories. And the last is unemployment. And unemployment's too low. Arguably, it's too low. There's too much demand for employees, which means that you still get to work from home when you want to. And if you want to quit your job, you can probably get hired at the next store for 15% more. That's kind of the word out there on the street. So Jay Powell, he gets an F across the board. He put us in a really dicey situation with his really aggressive monetary policy. And now he's using a sledgehammer and trying to crush the economy that they specifically created. They continue to rise, and they intend to continue to lift rates over the course of the near term, at least, until he sees inflation moderate, and his goal is 2%. Well, look, guys, we're arguably in a recession. We certainly were in a recession the first two quarters of this year. Recession simply defined as 2 quarters of negative growth, and for sure we had that. The third quarter this year, arguably we didn't see negative growth, but I think we can attribute that to inflation. Things just simply cost more. And so it looks like we actually spent more when we really didn't. I mean, here in California, we're paying over $6 a gallon for gas. It's ludicrous. So look, as the Federal Reserve continues to raise rates, there's a direct correlation between the Fed's funds rate and other interest rates for like your home or commercial real estate or your credit cards or your auto loans, all of which are going to adversely impact us. It's going to further depress asset values. And the thing is, although it took them 18 months to put $17 trillion into the economy, it could take years for that money to come out. But here's the thing, the bubble's already popping. And again, as I mentioned, there's going to be buying opportunities of a lifetime. We're seeing ludicrously low prices in certain asset classes, specifically commercial real estate. So, and I'll talk about that a little bit later in the equation, but let me just tell you this. For the prepared investor, we're going to see some generational wealth be created. Excuse me, should have turned that off. And that's going to be at least 24 months and probably closer to 48 months, as I mentioned earlier. It's going to take a long time for that liquidity to come out of the market. Commercial real estate is being disrupted in a way I haven't seen since 1992. In 1992, I was a young vice president running Bank of America's, or 3 different divisions of Bank of America, but we were selling assets, both notes and foreclosed properties, for pennies on the dollar. There was very few buyers, but there was a lot of sellers, and that's kind of the equation that we're getting to here in a moment. When during every cycle, every down cycle, every market correction, every recession, certain assets fall out of favor, and that's where we see massive buying opportunities. I expect it in a way that I haven't seen since, again, 1992. So it's times of distress and value corrections that fortunes are made. The landlord of America, known as Sam Zell, also known as the Grave Dancer, made his fortune, and he's a multi-billionaire. When I said the landlord of America, literally at one point, he had more real estate under ownership than anybody else. He made his fortune buying assets, pennies on the dollar. He was the guy buying what I was selling when I was with B of A. Here's a really, really important thing. More millionaires and billionaires are created during corrections because there is limited competition. And when there are far more sellers than buyers, we see massive discounts to previous value. Everything, my friends, is going on sale. So we're here to talk about commercial real estate and why it is the code to generational wealth, particularly when you buy it at distressed levels. Investment properties have been the single best way to create generational wealth in the US, proven hands down. Going back 100 years, its performance has outpaced the S&P by more than 700%, 7x the S&P, and that's before considerations such as generous tax benefits and a lot of one of the great things about the commercial real estate, it's a cash flow asset. And so distributions, look, if you take advantage of what I'm going to tell you and you follow the script, one asset will create generational wealth for you because it's going to cash flow like a madman. If you do it right, one deal. And I've seen it happen time and time again. So 80% of the millionaires and billionaires in the US earn the vast majority of their wealth through real estate investments. Benefits and compounding effects are unparalleled. So with commercial real estate, you get to write off your interest, you get to write off your depreciation, amortization. So even though you might net $10 million, you only have to put a portion of that on, you pay taxes on a portion of that because you get significant write-offs. And that's unparalleled in any other asset that at least that I'm aware of. It's a strong inflation hedge. Oops, strong inflation hedge. Um, it'll ensure steady cash flow, so you get this annuity. What's the brilliant thing when you invest, you end up, if you do things right, if you follow the path that I will give you, you end up with an annuity that is in perpetuity, and it's not just yours to benefit from. It's going to be your children because look, long-term investment in commercial real estate is what creates generational wealth, especially done well. You build substantial equity. When I say substantial equity, every time you make a mortgage payment, you're paying down principal. Commercial real estate is a hard asset which over time appreciates. Yes, there's going to be dips, and we're starting to see that now in a very, very robust way. But over time, again, it's outperformed the S&P by 700%. It is an asset that you want to invest in. I wouldn't be touching stocks today. I wouldn't be touching any of the cyber currency. That doesn't make any sense. Commodities are all over the place. Obviously, commercial real estate is near and dear to my heart. And I'm very passionate about it, particularly given what's going on today and the buying opportunities we're starting to see. But anyways, so to continue, you leverage substantially in commercial real estate, which is one of the things that hyper accelerates your returns. You can borrow, 50, 60, 70, in some cases more percent of the value of the real estate. And in doing so, the return on equity dramatically increases, like by an order of magnitude. Excellent appreciation of value, and we talked about that, all right. And it's also a very secure investment. I mean, barring a natural disaster or some other event, it's a secure investment. It's a hard asset that benefits not just you, but your extended family over the long run. It's going on sale. It will be your biggest single opportunity to create generational wealth and extraordinary passive income. So this is a chart of the S&P versus commercial real estate over the last 22 years, 21 years. Note a couple of things. One, commercial real estate is the top line, and obviously it's dramatically outperformed the S&P by almost 300%, but it's also more volatile. And so yes, it accelerates in price, and then it declines, and it's during these declines, these pullbacks, which are to me very predictable, that the buying opportunities are extraordinary. So why buy distressed commercial real estate? Well, between the discounts and the massive room for property improvement and enhanced flows of cash, an investor massively de-risks their investment. So what I mean specifically by that is this. When you buy, let's say we want to start small. Let's say we want to buy the liquor store that's on the corner. If the building, it was a liquor store, it's been vacant for 2 years. The previous business went out. The previous business owned the real estate. So it's been sitting there. It's likely in foreclosure. There's not even a for rent sign in the window. Your opportunity to step up and buy that at a massive discount, because there's no tenancy, there's no cash flow. All it is a negative cash drain for both the bank and the owner, is extraordinary. And those discounts could extend as much as 50, 60, 70%, which is kind of the nature of commercial real estate. Vacant buildings have far less value than occupied buildings because commercial real estate is a cash flow business. So you buy it at 50%, 60% of its previous value as leased. Now your basis is a fraction of all your competition's basis. There's four other buildings in the immediate neighborhood that look and park a lot like yours. So you buy it at a fraction of their basis. Now you're able to go and lease it out also at a fraction of what they're leasing their space for. So now you become by far and away the most compelling property for a new tenant who wants to open a business or relocate their business. And you could do so at a level that still provides you extraordinary cash on cash returns. That competitive advantage and that ability to create massive upside in valuation through cash flow is one of the things that is a driver behind this extraordinary investment in distressed commercial real estate. So, why doesn't everyone do it? Well, there's a lot of reasons. And one of the fundamentals is people don't like to buy when they're uncertain about the future. But it's exactly moments like that that create the opportunities that we're talking about. It's also a lack of knowledge and maybe a lack of experience. For most, it's just a little bit scary. Um, Let me just tell you this, that historically, commercial real estate has been the purview of either Wall Street or the family who owns that building or that property for generations. It's dramatically changed over the course of the last 10 years. There's a lot of there's a lot of people, guys, I'm talking to people and I'm coaching people today who have been flipping homes for the last 10 years and they've done fairly well. They're seeing what we can do in commercial real estate and they're mind blown. Commercial real estate is so much more compelling than single family homes for so many reasons. And they're jumping in and they're starting to really make fortunes. Again, it doesn't take much more than one deal. And by the way, once you do your first deal, it becomes addictive, becomes deeply addictive. The benefits of commercial real estate over flipping a single family home is it's almost incalculable. So, what is income property? It's real estate that produces income as a result of leases or other revenue streams. Other revenue streams vary, but hotel, hospitality earns their revenue not through leases, but from overnight stays. It can range from a liquor store on the corner to massive office buildings and regional malls. Generates passive income that is heavily tax protected with average yields that are in the 10 to 20% range. And if and far more if bought at a discount, and dramatic discounts are what we're talking about today, guys. And I'm not kidding. We're seeing price points that haven't been around for 30 years. It's a superior hedge inflation. We already talked about that. So why not this notion of flipping single family homes? Well, everyone's in that game. And that was certainly one of the things that drove home prices through the roof. Guess what? If you're in the game of flipping today, more likely than not, you're losing money. So you're buying at the top, never buy at the top. Always look for a bottom. Obviously, extraordinarily difficult to call a bottom, but when you're buying at such a huge discount, it doesn't matter if you pick the bottom. Be on either side of it and be happy. Volatile asset class. Single families tend to be extraordinarily volatile. I showed you that chart of the housing market in Phoenix. It's moved all over the place. Now, granted, that's a very volatile marketplace. Sorry. Wall Street will beat you every time in the single family home business. The black rocks of the world have been out there gobbling up portfolios of homes for an extended period of time. Thing is, their cost of capital is far lower than yours, so they have an innate competitive advantage. Um, they've got cheap money. You work for each and every dime in a market that is saturated and hyper competitive. I already kind of implied that, but look, it's difficult. I flipped a lot of homes before it was called flipping in the early 2000s. I was out by 2006. Probably got out a little early, but I saw that whole subprime meltdown coming. Wasn't difficult. As a banker, you're schooled in analyzing risk and determining where it is and when it's likely to occur. And so, yeah, myself and my mastermind group, we're like, this is not good. This is not sustainable. So we got out early. Again, probably too early, probably a year early, but you know what? Better safe than sorry. First rule of investing is what? Don't lose money. Second rule of investing is what? Don't forget number one. Uh, yeah. So let me talk about this too. This notion of being a contrarian. I said I got out of the market earlier. I got out in 2006. Then I went into trading. I've always had a deep love for trading equities, and I traded more options than equities themselves. And again, as I mentioned, I saw that crash coming. So in 2007, I sold a lot of stocks short, and I bought a lot of puts on stocks and sold some calls. Long story short, 2007, I put on one of the biggest trades I'd ever done. I invested $100,000 in a directional trade on two stocks. In other words, I expected these stocks to go down, and I doubled down on that investment. And those two stocks were First Federal Savings Bank and Downey Savings and Loan. They're both Southern California lenders, both deeply invested in the subprime space. And as opposed to most other lenders, they held on to their mortgages. They didn't securitize them and sell them off. They held all that really rotten, nasty paper. And so I'm like, okay, these guys are going down. So I put my biggest trade on ever. And that night, Kramer came out on Mad Money, and he said, "Look, if you're going to own any savings and loan, this is who I want you to buy. It's Downey Savings and Loan at First Federal Reserve because they keep all their paper. Their yields are through the roof, and they're outpacing in performance every other bank in their competitive set." And I'm like, "You fucking idiot! That is the worst advice I'd ever seen given." That night or the next morning, both those stocks popped significantly. I lost a lot of money, but I didn't close out my trade. I hung on to it. I hung on to it for 6 months. And by the way, this is a time where I'm the guy saying the roof is falling, the roof is falling, the sky is falling. You got to get out. And everybody was saying, no, no, single families don't go down in value. I'm like, oh my God, you are not paying attention. You are walking around with blinders on. I've been through two other cycles by that point, and yeah, I saw it. In fact, I sold a ton of single family homes that were REO or pre-REO, far off their value, far, far off. If I can buy 50% and sometimes more. So anyways, the story, the point of that story, guys, is that well, two things. One, you could be right in terms of your observation, but wrong in terms of timing. And that can be painful to stick with. Again, I held that trade for, I think, another 6 months. I think I quadrupled my money, and I got out early. Eventually, both of those stocks went to zero because both companies filed bankruptcy. Had I held on to those positions, it was $1 million trade, easy. But sometimes it's hard to stick to your guns when everybody else is telling you you're wrong. That's the hard part about being a contrarian, quite frankly. So why investment property now? We've talked about this a little bit. It's a investment properties are going on sale at ludicrous discounts. The wave is just starting to hit us, guys. There's a tsunami of defaulted mortgages coming our way. Over the course of the next 4 years, there's $1.2 trillion in mortgages that are going to mature on commercial real estate. A huge portion of those mortgages are not going to be refinanceable. Now, on the other hand, what I do, I work with borrowers sometimes. I've done this dozens and dozens of times over my career to modify their debt, to restructure their debt, to do what's known as a loan workout. The bank doesn't have to own the property. The borrower keeps the property. There's sometimes a mutually beneficial solution that I can come up with. That's not going to happen in more than 20% of those maturing loans. So there's going to be just a flood, a tsunami of opportunity coming our way. Today in the US, there's more than $300 billion worth of distressed commercial real estate. And look, that number is just going to grow. And as that number grows, that opportunity is going to grow as well. And my coaching to you is be prepared, because this is going to be the single best time in your life, as far as I know, to buy this investment, this extraordinary investment at a massive discount. Forbes magazine calls commercial real estate the perfect investment. And I probably could have just said that and been done with most of what I'm talking about, right? De-risking your asset, I've already covered that. So what causes distress? Excuse me. Physical, which is deferred maintenance, meaning the building's falling apart, needs a new roof, needs a new paint job. The parking lot's got weeds growing in it. The parking lot needs to be restriped. Poor location, obviously, location. This is obviously important for commercial real estate as it is in single family. And then obsolescence, a building that was built for a specific purpose that is no longer usable, or you can't find a replacement tenant because it would take too much to repurpose the building. Ownership, Ownership issues can cause distress. Disinterested owners are one of my favorite. It just simply means that they're not paying attention. And when they're not paying attention, the rents aren't nearly what they should be. They're a fraction of what they could be. So an easy fix is to buy it and restructure their leases. They might be allowing too much deferred maintenance. They might not be managing their expenses appropriately. Now there could be partnership disputes too. Guys that they were best friends. They were a married couple that bought a building. Now they're divorced, or the partnership dissolved, and that's causing conflict, which means that there's problems at the real estate level too, or limited capital. You ran out of money and you need to feed that beast because it needs a new coat of paint or the roof's leaking, but you're just either unwilling or unable to do it. So the biggest distress that I see coming here over the next few years is economic, and it mostly has to deal with leverage. Leverage means the loan associated with the real estate. Again, commercial real estate is the business of leverage and cash flow. Too much leverage or misplaced leverage is a huge problem in that space. And so, as an example, over the last, let's say you bought a multifamily building 6 months ago and you used an adjustable rate mortgage on it. Your cost of capital, your interest rate has probably gotten close to doubling over that period, which means that instead of having a yield, and by the way, your yield was probably very, very low because you bought it at the top of the market, you could be upside down. You could be upside down not only just cash flow, but also in valuation. So leverage is a huge issue. Maturing debt, as I mentioned earlier, is going to be a massive challenge here for commercial real estate in the US, but it's also going to be a massive opportunity. Maturing loans means defaults. Defaults mean distress. Distress means reduced pricing. Reduced pricing is where you step in, my friend. Loss of tenancy is a big issue too. Office buildings across the country are about 50% occupied as compared to pre-pandemic levels. And I don't know if that's going to change anytime soon. Look, I believe it's going to change. Getting back to this notion of artificially low unemployment, as this recession digs in deeper and takes a bigger bite out of our economy, we're going to be moving from an employees market to an employers market, meaning that the employee doesn't get to say, well, I'm just not going to work in the office. And if you make me, I'll go take that job down the street again for more than I'm making here. So why do properties sell for so little? Well, there's a lot of reasons, but look, lenders do not want to hold non-performing notes and REOs. They trigger large reserves. In other words, they have to set money aside on their balance sheet for future losses, which negatively affects their earnings. They also don't like the liability of owning commercial real estate or any other real estate, quite frankly. Oftentimes borrowers give up and just give up hope and just want out at any price. They're like, I'm done. I can't feed this beast anymore. It's been a bitch. It was great for the first 10 years, but for the last 5 years, it's been a nightmare. Emotionally and financially, you're just done with it. So you're ready to throw back the keys. Well, that's one of the reasons, certainly, why properties sell at massive discounts. And then also borrowers look to avoid triggering larger liabilities such as full recourse. So as an example, if you own a large commercial real estate building now and you bought it at or close to the top of the market, it's highly leveraged. You might have seen massive price reductions or value reductions in conjunction with the loss of tenancy or other cash flow issue. If you wanted desperately to hang on to the building, you could consider filing bankruptcy. Bankruptcy would trigger what's known as a bad boy carve out. This is stuff that we're going to cover in further courses. I'll talk about it later, but in our mastery course, where we dive deep into this stuff. A borrower files bankruptcy, and our loan documents today are very tight and they're very much negotiated in favor of the lender. If you file bankruptcy, you trigger potentially full recourse on the note, meaning that you went from being able to give the keys back and walk away to you can give the keys back, but if there's a difference between what you owe and the loan balance, you have to pay it out of pocket, kind of like a personal guarantee, and it's a nightmare. So how to make this whole notion of buying distressed commercial real estate? I hope I've made it clear that it is an extraordinary investment for so many reasons, and it's going on sale at prices that are probably once in a generation. Well, the 3 Ps. I told you that I do the workout advisory. I wrote a book called The 3 Ps. It's all about restructuring debt, but it applies here too because you start with a plan. You have to have a business plan around what you're going to do. The plan, if you're looking at buying that commercial asset, that liquor store on the corner, you have to have a plan. Like, okay, we need to restripe, we need to find the right tenant. The right tenant seems to be fast food or whatever. You need to have a plan. It's absolutely critical. And then you need to be able to project future cash flows. You say, okay, here's my plan. Here's what I expect in terms of future cash flows based upon that plan. And you can back into a lot of the things that we're going to talk about here, like your price, what you're willing to buy for the pay for the real estate. That's in the propose. You propose a price and a structure that provides you extreme value. So you've got this piece of real estate to the liquor store in the corner. It's been vacant forever. You know you can buy it at a huge discount. It's just been sitting there. You say, okay, if I want to buy this thing, these are the things I know I have to do. I have to paint, new roof, improve the interior, maybe new flooring or whatever. And then you project your cash flows around those. And you also estimate revenues and expenses. And you say, okay, at this price, it produces this kind of return. At this price, it produces a much better return. So I'm going to propose the price that gives me a return that's consistent with my potential risk in the deal. And for you, you might be looking for a 20% cash on cash return or there's so many different ways to slice that one. But look, the answer is you're going to be in a position to make offers on deals that in many cases are far, far, far lower than the seller would like to sell. They don't want to sell, fine. There's another deal just down the street. Commercial real estate is distressed today, guys, and it's going to get far worse. So yeah, 3 Ps, absolutely critical. And then the last step is execute, execute, execute. So in terms of planning and developing an investment thesis, I'm really simple around this one. You want to create a business plan for your investment business. And so you want to say, okay, for those of you starting out, let me just kind of give you some advice. One, invest in an area that you know well, which basically means your neighborhood or your city. No, invest in an area that you know well and you can drive and you can be part of and you can test the temperature and heartbeat of. You can also identify distressed real estate by just driving around and keep this in mind as you ponder what we're talking about here over the next week or two. As you drive down the street, you'll see that vacant building that's been vacant forever. You think, gosh, I wonder what's going on there. Or that mid-rise office building that's been vacant for the last 6 months. You think, there's distress. Or that hospitality that doesn't seem to have any guests, right? That hotel that has a fraction of the guests that they used to have. Those are all indications of distress. But target a market that you know, target a market that you live in. Then target an asset class that you'd be comfortable managing. I wouldn't suggest, as an example, hospitality for you first timers. It's more than just real estate. It's a business wrapped in a real estate envelope. But do something simple like a single tenant property, a liquor store. It's a great example, or maybe a laundromat, something along, or a retail strip center where you've got 2 or 3 tenants, so you diversify your income stream risk. I want you to start sourcing opportunities via brokers. Brokers are going to be your greatest asset. And here's the good news. Brokers are not very busy today. Commercial real estate transactions have come to close to a screaming halt. They're off 85% from where they were a year ago. And I have a deep heart for those guys, those who are willing to pivot and jump into the markets that we're talking about, which is the distressed world, could make an absolute killing. And then if as you start pondering this notion, start thinking about walking one of these properties each week. So you've got that single family or that single asset that's been vacant. Walk the parking lot, peek in the windows, take some notes, physical or mental, but start to engage yourself. Financial projections. I don't know where this came from. Anyways, one of the things that we provide our mastery students is a pro forma, and then we walk them through the creation of pro forma. Accounting is the language that we speak in commercial real estate. You need to be really, really familiar with it. The pro forma is absolutely critical to your success. If you don't have a pro forma, you have no business buying commercial real estate. So one of the things you're going to do is ID a competitive set of properties. If it's that liquor store in the corner, you're going to want to know what other stores of that size and type of location are charging for rents. And you also want to know what recent sales have been. Develop an understanding of cash flows as is and as stabilized. As is, there's zero cash flow in a vacant building. As stabilized, I don't know the number, net cash flow could be $200,000 a year. And that has a dramatic effect on value. So again, one of the ways we create massive returns is by buying vacant or low occupancy buildings and leasing them up at rates that are a fraction of their competition. And in doing so, create gross profitability. So the other thing you're going to need to do is begin identifying sources of capital. Now, most times when people get into commercial real estate, they source capital from families and friends, or you might have sold out of a single family home or two, and so you got a lot of cash you don't know what to do with. But start thinking about capital sources, and loan sources is also something you want to consider. Now, for the most part, commercial real estate is going to be financed by your local lender. It's not going to be the Bank of Americas of the world, although sometimes that is the case. I want you to also think about your minimum investment returns. I told you earlier that commercial real estate generally throws a yield somewhere between 10 and 20%. The reality is, for distressed commercial real estate, you could double that easily if you do it well. If you follow my guidance and follow those those steps I mentioned earlier, the 3 Ps. Proposal and asset plan. Look, I'm not going to go into great detail here, but you want to build an asset plan that discusses how you're going to go improve the property and attract tenants and stabilize it. It's not just a function of buying really cheaply. It's also executing a very comprehensive plan. You need a plan that talks about who you're going to attract as a tenant, what kind of lease rate you're going to charge them, what your projected capital improvements are. You're going to have to do new flooring, paint the exterior, have to put a new roof on, fix up the parking lot, improve some signage. I know it sounds expensive. You've all done it, right? It's not really that expensive. So yeah, here's kind of where I want to jump to. With a business plan, pro forma, asset plan, and obviously the proposal, you're in a position to raise capital and source debt with credibility. If you do the things that I'm telling you, you absolutely must do if you want to be successful, you're going to be so far ahead of your competition. It's ludicrous. Most people go and say, "Oh, that looks like a good deal. Let me just buy it and see what happens." Really, really bad idea. Have the 3 Ps in your back pocket, and you're going to look really good to your potential investors and to your lenders. And by the way, also to the potential seller, he's going to want to know that you have a plan and are ready to execute that plan. And also, once you close, you have a very succinct roadmap to success and taking advantage of those huge competitive advantages. Do you remember what they are? I hope so. Well, one is that your basis in the real estate is far below your competition, and you greatly de-risked your investment by being the low-cost provider for tenants. So develop relationships with those that have an established presence in the industry. The other day, somebody asked me, well, how do I do that? I'm like, okay, pick your market, pick your asset type, and start looking for signs, whether it's for sale signs or for lease signs. And more likely than not, you're going to see a name pop up over and over and over. And by the way, you want to work with the best and brightest and most successful in any market they're in. So that's where you start. Again, I want to point out that the good news is that brokers are not busy today, and you'll get that call back. Build your knowledge deeply and rapidly as possible. Find yourself a mentor ASAP. Look, you've got a little bit of time, my friends, but use that time wisely, whether it's husbanding your resources, gathering your assets, determining who could co-invest with you, or more importantly, building that knowledge that, as an example, I'm sharing with you here. Let me give you a great example of what we're talking about. This is only one example, but it's probably the most extreme that I've seen over the course of the last 6 months. This property known as AT&T Center is in St. Louis, Missouri. 2016, 6 years ago, it was valued at $210 million. Recently sold for $4.1 million. It sold for $3.25 a foot. I live in Laguna Beach. Single family homes are selling for $1,500 a foot. To reproduce this building would probably cost you $2,000 a foot, and you wouldn't do it. Not in today's market. Probably never again. It's a nightmare from every perspective. Offices are out of favor because it's of the work from home phenomenon. They will come back into favor. It's not like this office will never be used again and will sit vacant for the next 20 years until Armageddon occurs. Um, but it's an excellent example I would have been talking about, which is buy when everybody else is selling, and in doing so, you buy at massive freaking discounts. This is less than 1% of replacement value. So then the question is, when are you going to stop trading your time for money and start trading your money for time? Meaning that you do the right investments, it's now creating a passive flow of income, and your time is freed up to do the things that you want, which is spend time with your family, travel the world, go on vacation, whatever. This is a cash cow. These, if done right, if following my logic and following our lead and following our agenda, which is the three P's. If you do it right, look, again, one deal and you're done. You won't stop at one deal because they said it's addictive, but one deal, at least it's a great start. Options during a market correction, options during a recession, options when everybody else is selling. Well, you can live in fight, flight, or freeze, like most, or you can invest in the single most profitable asset class over the last 100 years at discounts that we may never see again. I am not trying to oversell this. I absolutely believe this, and we're building a huge fund to go out and start acquiring this. I'm not buying today, although I would for the right assets. We're looking at a lot of stuff, but there's more capitulation, there's more fear, there's more downside in commercial real estate. And it could be, 6 months, 12 months before we make our first significant investment. But here's the thing. I've said this before, buy when others are selling and sell when others are buying. Buffett said it. He said you sell into greed and you buy from fear. Baron von Rothschild said, buy when there's blood on the street, even if it's your own. Buying when everybody else is selling is when you create extraordinary value and establish a massive competitive advantage. Generational wealth is being created now. The only thing that's stopping you, my friends, is not your lack of knowledge, not your lack of capital, not your lack of network. It's your mindset and limiting beliefs. There's everybody has to get a start somewhere. And I'm telling you, and I think I've proven it to you, that commercial real estate is the single best investment over the course of the last 100 years, bar none. I'm not talking about individual stocks. Yeah, if you bought Amazon 20 years ago, it's far outpaced commercial real estate. I'm talking about the equities market in aggregate. Mindset is a huge barrier to entry for most people. So how do you profit from this once in a lifetime opportunity? You can invest with Wall Street's, and I will tell you that REITs, which are real estate investment trusts that own big portfolios of commercial real estate, are trading at deep discounts today as compared to where they used to trade, and in some cases to their net asset values. You could participate in crowd-funded investments. In other words, you could be an investor, a passive investor. That works, although I'm not suggesting that today, because most of the investments that work this way tend to buy at retail and not pursue the discounted and distressed assets that we're talking about. That's where the real vig is. That's where the real juice is. You can invest with others that are out there doing the work, like your buddy says, hey, I'm buying this building. Why don't you jump in with me? Definitely do that. You can become a wholesale or lead provider. I don't advocate that. There's a lot of people pimping that logic out there. And some people, maybe 1% or 2% of that crowd will make money doing so. But look, it's not a bad way to educate yourself on the business. But as a business that creates your primary income, I don't like it. Or you could become a contrarian, an expert, build your own life-changing portfolio and create generational wealth. And that's where I want to see you go. I want you to get rich. My goal is to create millionaires, lots of millionaires over the next few years. And that's what we teach. So that final point, we teach a course called, it's the mastery course, the code to generational wealth. This is an intro to that. During a 6-week period, we dive deep into all the aspects that you're going to need to know to be successful in commercial real estate investing. So you define your market, you ID distressed opportunities. And this is, by the way, not a complete list. It's just kind of the high points. We teach you how to underwrite a property. We teach you how to capitalize, in other words, raise money, and how to document your equity, how to document your investors. We teach you how to close on your transaction. We teach you how to manage to enhance value, which is huge. I pointed out without a good asset management plan, you're done. You need to have a real clear, decisive plan. And then I'll teach you how to refinance it. Once you created this extraordinary value, guys, you're going to be in a position to refinance and more likely pull at least all of your equity out and go deploy that somewhere else and have this property now, which is cash flowing like a madman on a passive basis, feeding your bank account or your investors and your investors' bank accounts on a monthly basis. In this course, again, it's done over a 6-week period. We drip it to you. You can't do it all in a single week. I don't want you to. You take one of the courses, say on a Monday, and then we do a mastermind, which is part of the course cost, on a Friday. In between Monday and Friday, I ask you to do some homework, whether it's defining what market you want to play in, what asset type you want to play in, defining, maybe picking out or pointing out certain distressed properties you think might be available. So it's a very scheduled and tempered approach to giving you the tools that you need. We limit each class to 10 individuals because of the mastermind or the weekly coaching component of it. I don't want any more than 10. During those coaching and mastermind sort of sessions, if you will, we dive deep into things like underwriting. And we point out the problems, we point out the errors, we point out the solutions, all giving you the education and the skill set that you need to absolutely crush it. Next step for you is to book a call. I'm not going to send you to a website. I don't want you to check out. I don't want you to buy the program now. I want you to book a call. I want to make sure that you're right for this space, that it's something that you are committed to. Our group coaching sessions are really powerful. They're really powerful, and the level of energy and excitement around them are extraordinary. And I want to maintain that. So I want to vet. And you know, if you're on the edge or on the, yeah, if you're tilting one way or the other, on sitting on the fence, I can nudge you one way or the other. Anyways, look, I hope you enjoyed this. I hope that, it looks like my video froze. I hope this was of great value for you. And reach out to me. Reach out to me, book your call, and let's get this rocking, my friends. I hope you enjoyed this. It was my pleasure to teach you. A lot more to come. In the meantime, enjoy your day.